Good morning, folks. Welcome to the Sense of Things with Jeff and Ron. And this is a special episode focused around the mid-year and where all of our friends in the analyst community have completely revised their numbers. I'm sure, again, Ron's going to cover that. So stay tuned. We'll be right back on in just a second. Hey, everybody, welcome to the show. Ron, how are you, my friend?
Good morning. Good. It was interesting because I like to be the keeper of the information sometimes and kind of doing research on where some of the market analysts are, more for entertainment fodder than anything else. But I thought it was pretty interesting. And then obviously also like what were our predictions, not only for the market, but
Yeah.
also for sectors, what to look at and what to avoid. So kind of looking at the chart here, some of them I couldn't, I tried to. But many of them reiterated. There were several that increased, but I thought three that stood out to me because right now the S&P 500 said 75.19. It was at 74.80 something close of yesterday. But I found that Bank of America was very interesting. They have not increased it, being the biggest name out here next to HSBC and CFRA. But this is essentially 7% under where we are right now, 8%. And looking at this, I think it's about 5. I think it's just very interesting because they're saying we're going to be lower at this. If they haven't increased their price target, and obviously they see a lot of things that are out there, that obviously a lot of positives in the market, which is why you got Morgan Stanley saying what they did say about the Mag 7. They're trying to push this thing another 500 points higher by the end of the year. So I thought those three that reiterated were interesting. Meanwhile, Oppenheimer and Deutsche kept their price targets at 8,000, 8,100, and they could be right. I don't know.
Yeah. And Bank of I think my favorite, because I do read the Bank of America report, and their analyst that covers that's their lead analyst on that, is just straight up, flat out, unbelievably wrong consistently. And if you listen to his advice, you would not make any money. They are just flat out wrong, and they are just going to keep him in his chair and let him be wrong like crazy. I agree with the Oppenheimer and Deutsche. Not changing any of my views for this year. Honestly, I think the market's probably going to close around 8,000. I don't even remember what we said at the beginning of the year.
You'll see it.
All right, we'll see. I don't even remember what I said, but I agree with him. I think we're still going to keep climbing the wall of worry. And I think the S&P is going to be somewhat muted because the powerful engine that it has been, if you watched our last show, the powerful engine has been the Mag 7 stocks because they were 30% of the index. And I think they're somewhat muting the performance of some of the other stocks this year.
And I also kept their 2025 numbers because the number on the left in the 2025 column was what they came out at the end of 2024 for 2025. And the reductions were within 30 days after the tariff tantrum last April. And you could all see now where their numbers are for what they say for 2026, less than 2 years later, 18 months later, where they expected. Look, nobody wants to be wrong, but with this, it is a dart throw. There's no other way to say it.
You look at Zacks and Scotiabank, it's okay. Once again, if you listen to their advice, you would never make any money. And it's amazing to me that they actually still have a business in those cases.
But here's the interesting thing. We truly go to a full-scale war, and we don't have Europe or many of the other countries and alliances backing us up. Yeah, we could see it easily a 10 to 15% hit in the market. I'm just thinking.
We could, but the market's been pretty damn resilient. We were.
But you know what? If oil gets back over 100 to 110 and we can't get goods here and the supply chain seizes up, I'm saying you'll see a 10 to 15% hit. So that's why these numbers are all over the board.
Yeah. Yeah. Once again, some of these guys I don't even remotely listen to at that point. I listen to
Gold purposes for you and me.
I listen to Goldman Sachs because they are pretty much always the smartest guys in the room. Morgan Stanley has good stuff. Bank of America, I wouldn't listen to if you paid me money.
I like Mike Wilson at Morgan Stanley. I mean, and even he'll say, look, trying to predict anything is difficult.
It is.
Here's what we see good in the economy. Here's what we see bad. This is
Yeah.
what these market strategists will do. To me, the ones that I've always had the issue with are not the bearish ones. It's the ones that are just the bullish ones. Just keep pumping it up. Just keep up, because ultimately, yeah, we'll be higher. But many people are quarter to quarter based, which they shouldn't be. But you got to just be realistic. And I just found most of these market strategists, they're towing the company line. They're not independent. That's my opinion. We beat this to death over time.
Yeah.
All right. Next. So here we are. This is what you and I said for the calendar year. And when we announced these numbers, it was December 17th when the market was at 67. Today we're at 74.82. So we are over 750 points higher in the last 7.5 months or 7 months.
Crap. If we just stay flat to a little bit more, I can get my bullish case in for the year. But yeah.
And your base case.
Oh, I know. I'm right at my base case at this point, but I still have another half a year to go. So it can go either way on me at this point, and I don't want it to be the bear case. So we just...
I just think it's funny, though. Like I said, I thought we definitely would be higher, obviously, but I didn't think we'd be this high at this point. I thought this would be relatively a flat to negative year. If we were up, I didn't think we'd be up 10%. It's just insane.
Yeah. The funny part is I laugh, though, because I'm like, my portfolio that I run for clients really has absolutely very little component cross to the S&P. And I'm like, we're up a lot more than... I'm not excited about the S&P this year, but it's still a really good year for the S&P. We're still up, what, 8% year to date?
Greedy, my man. People are greedy.
That's a really good year normally. And we're halfway through the year. So if we went flat for the rest of the year, it would still be a pretty damn good year overall.
I agree. All right. So then what did we see when it came to areas to invest or areas to avoid?
Yeah.
These were sectors to consider. Now, I will say, in a bit of flag waving, my biotech, the IBB, had hit all-time highs in the last 2 weeks and has been going up. The BBH, which is the mid and the small cap, is at a 5-year high and approaching all-time highs. So the biotech finally broke out in the last month. The defense and aerospace has still been pretty positive. AI and robotics, yeah, it's been flat recently, but it's been doing very well. And I said, by the way, I put it in the boat, real estate would be good if the 30-year treasury would go down, which it has not been. What are your thoughts on where you thought you should put money?
So theme was industrials and natural resources is one. The industrials portion of that sleeve, crushing it for the year, absolutely crushing it, because it's industrials, construction company, stuff like that. We rotated out of the natural resources portion early in, let's call it February-ish. So it's more aligned to the industrial side of it right now. Tech and communications, the 5G and future communications, crushing it this year. And clean energy, you laughed at me, my friend, but that is my best performing sector this year is clean energy.
I haven't tracked it.
It's crushing it. That sleeve, that full sleeve, not the ones we're invested in, but the full sleeve it's up like 48, 50% for the year, just crushing it, because part of this is with these data centers. My theme was around data centers. So these are the components of it. And my theme with that was, I knew what was going to happen because there's such a resistance to these data centers because of energy and water and all that they're going to have to put in their own power plants, basically. And that all kind of falls under the clean energy realm.
All right. And then we said these were the sectors to avoid. If it wasn't for the war, energy and oil would have been flat again, but that has actually done well. So I didn't call that right. And I did say about consumer discretionary has just been bad investment.
Sucks.
But the real estate, I put that in here also because
you hedged your bets.
30-year doesn't go down, and keep away. And basically they came out with housing numbers today. They were flat. It's going nowhere. What are your thoughts on your stuff?
Health insurance has actually crushed it this year. Utilities actually have been really good, surprisingly. And my belief on the pure AI side, I think, has been completely right. It's been, especially the hyperscalers have just wildly underperformed. Where you make money on the AI side has been downstream of the component producers and not necessarily the big plays on AI at that point. So I was correct there. Health insurance surprisingly has been really good this year. And like I said, utilities has been, if you looked at
They've been doing
the
well.
sector map, they've actually been up towards the top, which surprises the heck out of me. So, hey, whatever. My other pieces have been fine. So yeah, if I avoided the other ones, I don't care at this point. It's worked out.
No, I hear you. So that was a quick overview.
Yep.
We got so far mid-year. We'll do it again in December. It should be interesting to see. I would expect not by the end of July. I would expect by September, October, before the midterms, as people see things shaking out towards the election, that we may get some end of year revisions, which is stupid. You're going to give an end of year revision with 3 to 4 months to go, but it'll happen.
Oh, I would not be surprised to see that. But yeah, that it doesn't surprise me ever when you see this with these guys. They try and keep their job by, oh, look, I hit the number on. You revised it 4 times during the year. We don't. We give a baseball and bear case. And good on both of us because we're right on track in all cases.
Good. Like I said, it's interesting. Like I said, we'll touch upon this between now and the end of the year, but we'll do another end of year going in the next year. It's always good conversation.
That's always the fun one anyhow, and kind of talk about our themes for the next year. So I'm already formulating my themes for the next year at this point. So I'm excited about it. All right, folks, thanks for joining us once again. We do these shows for you, and this was one of those special shows. So if you don't subscribe to the channel, you may very well miss it. So make sure you subscribe, and we'll see you guys back here the very next time.